Hi everyone, welcome to this session of the Tiger Academy, how to choose your US stock trading account. After going through the previous lessons, you should have a clear understanding of the ticker symbols for US stocks and the trading hours of the US exchanges. In this lesson, I will tell you how to choose what type of trading account. I'm sure you already are familiar with the concept of an account. The most common type of an account is a bank account, in which the inflow and outflow of funds are accurately recorded. A stock account is used to accurately record the types, names, and quantities of securities held by an investor along with corresponding changes in their rights and interests. In this lesson, I'm going to tell you about stock accounts in detail. First of all, there are two main types of US stock trading accounts, a cash account and a margin account. Number 1, cash accounts. In a cash account, as the name implies, you must pay in full for the securities you buy. You can only buy as many shares as there is cash in your account to cover the transaction, and you can only sell the number of shares that you hold in the account. There is no ability to use debt, and so there is no interest charged. For example, if you have $1,000 in your cash account, you can only buy shares with a market value of $1,000. Similarly, if you hold 1,000 shares of a company stock, you can only sell 1,000 shares. Use the TigerTrade app to look at cash accounts and it will become clear to you. On the account page, you can view the profit and loss cash position. Click on orders to view your order history and click on analysis to view the yield and profit loss of individual stocks, which can help you better analyze and review your trading. In addition, you can click on account to view more account data. There is a special indicator that needs to be mentioned here: risk status. Risk control status is generally represented in the TigerTrade app by current excess liquidity and overnight excess liquidity. For example, in this image, you can see that the overnight risk level here is green, which means that the current surplus liquidity is sufficient and very safe. When the overnight risk level turns yellow or red, most investors will start to worry. In fact, there is no need to worry. Only when the remaining liquidity is less than zero will there be a forced liquidation. If you only use cash to buy shares and there is no margin trading, generally, you'll not need to worry about margin calls. As for the meaning of margin trading and forced liquidation, you will understand that after learning about margin accounts. So, what is a margin account? Number 2, margin accounts. A margin account can be used for financing and securities lending. In the case of margin financing, the broker will use the assets in your account as collateral and will provide you with a loan to purchase more stocks than the cash you have in your account. In return, you'll be charged an interest on the loan given to you. Do you remember to check out what is the prevailing interest rates on website regularly, as they do change from time to time? Also note that different interest rates are changed for different currencies. Financing refers to borrowing funds from a brokerage firm to buy securities, while securities lending refers to borrowing securities from the brokerage firm and then selling them. This is also known as short selling. Why use a margin account? The Greek mathematician and physicist Archimedes once famously said, "Give me a place to stand and a lever long enough, and I shall move the world." This is actually a very apt description of the power of leverage. In the stock market, a margin account can give you that kind of leverage. For example, if you buy shares for $5,000 in a cash account and the stock price rises, making the value of your holdings $7,500, you will make $2,500, a 50% return on your investment. Now suppose you only have $5,000 in cash, but you want to get a bigger return. What can you do? Well, you could borrow money from the broker. Using your margin account, you can borrow $5,000 from the broker and increase your principal investment to $10,000. When the stock price goes up, as in the previous example, your holdings will now be worth $15,000. Upon selling the position, you return the $5,000 you borrowed to the broker and you keep a profit of $10,000, a 100% return on your original principal. That means you can make a full 50% more profit by using margin. So, the margin account adds leverage to your investing because you can use the borrowed funds to increase your position and double your profit. Many investors will ask, if I use the margin to double my profit when the stock price goes up, won't my losses also double if the share price goes down? The answer is yes. Margin is a double-edged sword, so you need to be extra careful when using this type of account. Make sure you understand how margin works before placing trades with it. Number 3, how a margin account works. There are 3 things you need to know about how a margin account works. The first point, margin requires interest and collateral. We all have some experience in life. We know that if we borrow money, we'll have to pay interest, and we know that loans require collateral. The same thing goes for margin trading. It also requires collateral and paying interest on the amount you borrow. A leveraged purchase of securities requires the use of cash or securities already in your account as collateral for a loan. For example, if the initial margin requirement is 60% and you want to buy $10,000 worth of stock, your margin is $6,000. In other words, you must have at least $6,000 in cash or securities in your account in order to make the $10,000 purchase. The second point, margin fluctuates with the stock market. Your margin will change according to fluctuations in your market transactions. This is not a good thing for investors. Why? Let me give you an example to help you understand. Suppose you have $10,000 in your stock account and you buy $12,000 of Apple stock on margin. If the opening and maintenance margin ratio for Apple is 50%, then the remaining liquidity of your account is calculated as total assets minus account maintenance margin. Let's say the price share falls and the market value of your shares is now $8,000. At the same time, the maintenance margin ratio has also increased to 80%. So the remaining liquidity of your account is now calculated as total assets minus account maintenance margin. Obviously, the remaining liquidity in your account has now fallen below the broker's minimum margin requirement. As a result, the brokerage firm will be alerted that the assets in your account are not sufficient in value to cover your margin, and they will send you a request to add liquidity to your account. This is called a margin call. Faced with the broker's margin call, you have 2 options. The first option is to increase your account margin as requested. At this point, you should be aware that due to the minute-to-minute fluctuations of the stock market, it may be too late to inject additional funds, or maybe you can't put together the required funds on such short notice. In that case, you can choose to voluntarily liquidate the position and avoid more risk and uncertainty. If you don't have enough cash and you choose not to liquidate your position, you may encounter the second situation, forced liquidation. Forced liquidation means that the margin available in your account is lower than the maintenance margin required by the brokerage firm, and they will unilaterally sell some or all of your shares to cover the margin call. Usually, there is no advance notice given on the forced liquidation of your shares. So, at the first sign of a margin call, when the stock price fluctuates sharply, be prepared in advance to increase the margin. Of course, the best way to avoid all of this is to reduce your trading leverage. The third point, if you cannot meet the margin requirements of the brokerage, any of your holdings may be liquidated at random. When you own shares in multiple companies, forced liquidation rules allow the broker to randomly sell any of your holdings, not just the shares that triggered the margin call. This is a rule that usually comes as a shock to many novice investors in US stocks. So, if you use margin to trade stocks, always pay attention to the risk state of your margin account. The current excess liquidity during the trading period should always be greater than 0. Otherwise, you may be forced to liquidate part or all of your positions. At this point, I'm sure you already know the difference between a cash account and a margin account. That's all for today's lesson. Let's sum it up. Cash accounts, margin accounts, how a margin account works. Thanks for participating. I believe you all are now able to understand the main points of cash accounts and margin accounts. To put it simply, cash accounts use real money to trade, while margin accounts use leverage, thus increasing your returns as well as your risks. In the next lesson, we'll explore how to go long and go short so that you can profit from your trading no matter which direction share prices move. I'll catch you in the next lesson.